In the chaotic, sentiment-driven world of cryptocurrency markets, investors are perpetually searching for reliable signals amidst the noise. One of the most intriguing and historically resonant signals has just flashed: the reemergence of a prominent regulatory critic, specifically CTA Chair Gary Gensler, delivering pointed warnings at a moment of market fragility. This phenomenon, which we can term the Gensler signal, is not about the content of his message, but about its timing, context, and the market's conditioned response to it. It operates on a core principle of contrarian investing. When a universally recognized authority figure reiterates a maximum fear narrative, it often indicates that the negative sentiment is fully priced in and exhaustion is near. This signal is powerful because it synthesizes three critical elements: psychological market cycles, political and media choreography, and the evolving maturity of the crypto investor base. First, we must understand the psychological cycle this signal taps into. Financial markets, especially nascent and volatile ones like crypto, move in waves of greed and fear. A true market bottom is not marked by a lack of bad news, but by an abundance of it, when the final holders capitulate because they can no longer bear the relentless negativity. The re-entry of a figure like Gensler, whose agency is synonymous with regulatory risk, acts as a crystallizing event for that pervasive fear. His statements labeling Bitcoin a risk asset and questioning the fundamentals of other tokens are not new. They are a reprise of a well-known song. However, when delivered during a price decline, they serve as an official-sounding validation of every doubt a nervous investor holds. This creates a sentiment crescendo. For the seasoned observer, this crescendo is a clue. It suggests the negative narrative has reached its peak volume and is now being broadcast to those last few listeners who are still tuned in. Historically, when the most predictable source of criticism makes its most predictable argument at a moment of maximum pessimism, it often marks the point where sellers have nothing left to sell. The fear becomes priced in, and the market, having anticipated the worst, finds a reason to stabilize and look forward. Second, the signal's power is amplified by its political and media context, which feels choreographed to long-term observers. As noted in the discussion with analyst Ron Hammond, this regulatory commentary rarely occurs in a vacuum. It frequently coincides with a surge in negative legacy media coverage. Think investigative pieces on exchanges, money laundering allegations, or profiles of fallen industry figures, all timed around critical congressional votes or policy decisions. This pattern creates a FUD barrage, fear, uncertainty, doubt, designed to shape public and legislative opinion. The Gensler signal is thus not just one man's opinion. It's the opening act in a coordinated theatrical production. The playbook is recognizable: regulatory warning, media amplification, legislative pressure. But for the market, this choreography has a diminishing returns effect. Each successive cycle educates more participants about the script. Investors begin to see the negative headline not as a novel reason to panic, but as a tactical move in a larger political game. This realization fundamentally changes the market's reaction. Instead of triggering sell-offs, these events can start to trigger eye rolls and accumulation strategies, as they are interpreted as last-ditch efforts to suppress an asset class whose institutional adoption is becoming undeniable. The signal, therefore, becomes a marker of the industry's resilience and a sign that opposition is moving from substantive critique to procedural theater. Finally, the efficacy of the Gensler signal is a direct measure of the crypto market's maturation. 5 years ago, a stern statement from Takeaways could trigger a double-digit percentage drop. Today, the reaction is markedly muted, and the conversation immediately pivots, as it did in our interview, to countervailing institutional forces like Vanguard and JP Morgan offering Bitcoin ETF. This shift is profound. It indicates that the investor base has diversified and sophisticated. The market is no longer solely held by retail investors, easily swayed by headline risk. It is increasingly underpinned by institutional capital, long-term holders, and complex financial strategies like borrowing against holdings that are indifferent to short-term regulatory posture. When Gensler speaks now, a significant portion of the market hears an echo of past cycles rather than a prophecy of doom. They are listening for the fact of his commentary as data, a potential sentiment extreme, rather than the content of his commentary as advice. This behavioral shift turns the signal on its head. The authority figure's warning becomes a lighthouse for contrarians, not a siren for the panicked. In conclusion, the Gensler signal is far more than a news headline. It is a multi-layered market indicator that synthesizes crowd psychology, political theater, and structural maturation. It suggests that when the most predictable source of fear speaks its lines on cue, the market has likely already written the next act. One where exhausted selling gives way to a new equilibrium. It does not guarantee an instantaneous V-shaped recovery, but it does highlight a moment where the balance of probabilities may be shifting from reactive fear to strategic accumulation. In the search for a bottom, one looks for the point where bad news loses its power to drive prices lower. The return of the critic-in-chief, met not with panic, but with a measured discussion about institutional adoption and lending strategies, is a compelling sign that we may be approaching that very point. The narrative surrounding Bitcoin is undergoing a foundational transformation, moving it from the periphery of digital gold, held in speculative wallets, to the center of a sophisticated institutional credit revolution. This shift is not merely about price appreciation. It's about functional utility. Bitcoin is evolving from a store of value asset to be simply held HODL into a productive financial instrument, a collateral base for generating liquidity, enabling complex strategies, and integrating with the broader, traditional, trad financial system. This revolution is being driven by three converging forces: the legitimizing entry of legacy financial titans, the formalization of a powerful, buy, borrow, never sell wealth strategy, and the rapid maturation of lending products tailored to client-specific goals, not rigid protocol. The legitimization phase, led by the seismic entry of firms like Vanguard and JP Morgan, cannot be overstated. For years, these institutions were the archetypal skeptics, their reluctance a key barrier to mainstream adoption. Their reversal, offering Bitcoin ETF access to millions of clients, a Rubicon crossing event. This is not a speculative bet by a fringe hedge fund. It is a strategic, compliance-approved product rollout by the custodians of global retirement and brokerage accounts. This action performs two critical functions. First, it confers unprecedented credibility, signaling to the entire financial ecosystem, from family offices to financial advisors, that the asset class is now a legitimate, allocable component of a portfolio. It moves Bitcoin from the alternative column to the strategic asset column. Second, and more importantly for the credit revolution, it creates a new class of holder: the institutional-grade, non-selling investor. These are entities and high-net-worth individuals who acquire exposure through regulated, familiar channels and have zero intention of engaging in the volatility of daily crypto exchanges. They seek not to trade the asset, but to utilize it. This creates a massive, latent demand for financial services built around Bitcoin ownership, with lending as the primary and most logical utility. The question from these clients shifts from "what's the price?" to "how do I make this asset work for me while I keep it?" This leads directly to the core strategic narrative now defining the space: buy, borrow, never sell. This philosophy, a direct parallel to long-established real estate and equity strategies, is the engine of the credit revolution. Its power lies in solving the central paradox of a winning investment: how to access the wealth it creates without relinquishing ownership and future upside, and without triggering a taxable event. By using Bitcoin as collateral for a dollar loan, investors unlock liquidity for any purpose: business investment, real estate acquisition, tax settlement, lifestyle expansion, while their Bitcoin remains securely held, continues to potentially appreciate, and avoids capital gains taxes entirely. This transforms Bitcoin from a passive, hope-based investment into an active capital engine, The strategy acknowledges Bitcoin's volatility not as a bug, but as a managed variable addressed through conservative loan-to-value, LTV, ratios, and risk mitigation features. This never sell mantra is philosophically and financially profound. It aligns with the strongest convictions of long-term Bitcoin believers while providing the practical liquidity demanded by sophisticated wealth management. It's the bridge between ideological hodling and pragmatic finance. Finally, this revolution is being operationalized through a client-centric product evolution that is moving far beyond the one-size-fits-all loans of the past. The early days of crypto lending offered rigid terms, short durations, and a take-it-or-leave-it approach. Today, the market is innovating to meet the nuanced needs of the institutional and high-net-worth client. As detailed in the discussion, this includes the introduction of long-duration loan terms 3-5 years, which align with multi-year business or investment ROI cycles. Something previously. It includes flexible financing options such as loans without mandatory monthly payments, which ease cash flow management for borrowers. It involves tiered LTV and rate structures, allowing a retiree seeking a conservative Bitcoin-powered lifestyle income to access a 20% LTV product. An entrepreneur funding a new venture might opt for a 50% LTV. Furthermore, features like downside protection shields and automated stabilization, which allow for collateral to be sold at a preset high and repurchased at a lower price during a crash, provides sophisticated risk management tools. This shift from a rigid protocol to a flexible, tailored service suite is the final piece of the revolution. It demonstrates that the industry is no longer just building for crypto natives, but is architecting robust financial infrastructure capable of serving the most demanding traditional investors. The conversation is no longer about if Bitcoin can be used as collateral, but about how optimally it can be structured to meet specific complex financial goals. In summary, Bitcoin's institutional credit revolution marks its arrival as a mature financial asset. The legitimizing stamp from TradFi giants creates the holder base. The buy, borrow, never sell philosophy provides the strategic framework, and the explosion of flexible, tailored lending products delivers the execution capability. Together, they are dismantling the final barriers between Bitcoin and the world of structured finance. Bitcoin is no longer just an asset on a balance sheet. It is becoming the collateral base for a new wave of liquidity and economic activity, cementing its role not as a rebel outsider, but as a core component of the future financial system. Looking towards 2026, the trajectory for Bitcoin and digital assets is increasingly shaped by two powerful, converging forces from the traditional financial and regulatory world: monetary policy and legislative clarity. This outlook moves beyond speculative price predictions, focusing instead on the fundamental environmental shifts that will dictate market structure, product innovation, and strategic viability. The anticipated pivot by the Federal Reserve towards a rate-cutting cycle, coupled with the high potential passage of foundational legislation like the Clarity Act, promises to create a macroeconomic and regulatory backdrop that could accelerate institutional adoption, enhance product sophistication, and solidify crypto's position within the global financial system. The first major lever is monetary policy, specifically the transition from a restrictive to an accommodative stance by the Federal Reserve. While the direct, overnight impact of a 25 or 50 basis point cut on crypto loan rates may be gradual, its symbolic and structural importance is monumental. In a high-rate environment, the cost of capital for all lending institutions rises, constricting the flow of funds and keeping borrowing rates elevated across all asset classes, including crypto-backed loans. As the Fed initiates a cutting cycle, it signals a fundamental shift in the cost and availability of capital. For digital asset lenders who source capital from traditional banking partners and institutional lenders, this easing translates into a lower cost of funds over time. This will intensify competition in the lending space as platforms can offer more attractive rates to borrowers, a dynamic already beginning but poised to accelerate. More critically, rate cuts are historically correlated with increased liquidity, seeking yield and growth. As traditional fixed income yields fall, institutional asset allocators are compelled to look for alternative yield-generating strategies. A well-structured, collateral-secured crypto lending market presents a compelling new avenue. Therefore, the Fed's pivot isn't just about slightly cheaper loans. It's about opening the liquidity floodgates from vast pools of institutional capital that have been sidelined by both high rates and regulatory uncertainty, directly addressing, for better terms. This leads to the second, and arguably more critical, pillar for 2026, the move from regulatory ambiguity to legislative and tax clarity. The current state of regulation by enforcement in the U.S. creates a paralyzing uncertainty for many traditional financial institutions and publicly traded companies. The potential passage of a comprehensive framework like the Clarity Act represents a watershed moment. Such legislation would provide the rules of the road that institutions desperately require. It would delineate jurisdictional boundaries between the CC and CFTC, define what constitutes a security versus a commodity in the digital asset space, and establish clear custody, consumer protection, and operational standards for compliant companies. This clarity does two things. First, it acts as a massive risk mitigator and onboarding ramp. Banks, asset managers, and fintech companies that have been watching from the sidelines due to compliance fears would have a legal blueprint to follow, unleashing a wave of new product development, partnerships, and capital allocation. Second, it protects and empowers legitimate operators while targeting bad actors, fostering a healthier, more trustworthy ecosystem overall. Simultaneously, the evolution of tax policy is a key strategic variable. The move by jurisdictions like Japan to harmonize crypto taxation with traditional financial assets, a flat 20% rate aligning with stock market treatment, sets a powerful precedent. In the U.S., the push for clearer, potentially more rational crypto tax rules in 2026 will be a major focus. Clear tax treatment reduces the administrative burden and fear of unexpected liabilities for investors and corporations alike. More importantly, it formally recognizes and codifies the tax advantages of certain strategies, particularly the borrow, don't sell model. When tax law explicitly acknowledges that borrowing against an appreciated asset is not a taxable event, it transforms a savvy loophole into a sanctioned wealth management strategy. This endorsement from the tax code would trigger widespread adoption by financial advisors and accountants, bringing the Bitcoin lending strategy to millions of retail investors through their trusted professional channels. It moves the strategy from the crypto edge to the financial mainstream. Together, these forces create a powerful flywheel effect for 2026. Lower rates and increased liquidity from traditional finance, lower the cost of capital, and increase demand for yield-generating crypto strategy. Simultaneously, legislative clarity reduces the compliance risk that has been the single biggest barrier to entry for major institutions. Clear tax rules then provide the final calculable incentive for both institutions and individuals to engage in sophisticated strategies like lending and staking. The result is a professionalized and integrated market. We can expect to see a proliferation of structured products, more seamless integration of digital asset lending into traditional wealth management platforms, and the emergence of hybrid financial services that treat Bitcoin and Ethereum not as exotic bets, but as standard yield-generating collateral classes alongside securities and real estate. The outlook for 2026, therefore, is not merely bullish on price, but bullish on infrastructure, legitimacy, and utility. It points to a year where digital assets are less defined by speculative rallies and more by their deepening, irreversible embeddedness in the global financial architecture.